Welcome to Stock Odds, Odds and End podcast. This is Dave and Rob getting ready for the week ahead. Good evening, Rob.
Good evening, the Dave and Rob show here. We're coming to you on a Sunday. We'd like to do this on a Saturday, but last couple times it's been other things that have interfered. So our apologies. We'd like to get it to you sooner, but hopefully you get a chance to audit this before the start of trading tomorrow. So we'll get going here. So reviewing Friday's performance, you can see that all the sectors here were down. That's the broader market sectors, not necessarily the S&P 500, but I could see technology was the one that took it on the chin the most with cyclical. So, it was really a risk-off day on Friday, and there was expiration. So our seasonality had it pegged as a down day, and it did not disappoint us in that respect. And it was a pretty a large expanded trading range session. So we'll look at that in a moment. For the week, technology still came in at the bottom, and utilities was a change that, and we saw that the week previous as well, that utilities were springing back because they had been lagging all year. So we see them kind of popping up during challenging times and times of more concern. I would say that the markets have seen greater risk elements come into play. And although it's September, which is historically a softer month than the other months of the year, we saw a beautiful rally into the end of July with some window dressing and so on. Pretty robust earnings season, but we turned the corner in August, and we've been sort of sliding down since then. Even though it's not been a massive correction yet, we're not done September, and then we get into the most volatile month of the year, which is October, and anything can happen there, rallies or sell-offs. So, get yourself familiar with this, and there can be some reversals after expiration, like maybe not as strong for September, although we just had a quarterly expiration, but we always keep our eyes open for, is there a potential change in the week following expiration? Did you have a down week? Did it end on a sour note? Okay, is it potential that it can bounce back? And the answer is yes. Of course, no guarantees, but certainly something that we look for. ETF performance. So as you could see, we can go into the market ETFs, Diamonds, Russell 2000, IWM, Qs, NASDAQ 100, and the SPY, S&P 500. The four market ETFs all down, with Qs being the one that was down the most on Friday. And then again for the week, we can see that Qs and SPY were tied for the week. And this isn't open to close, like open of the week to the close of the week. This is basically the close of Friday to the close of Friday. So it's all based on a close-to-close basis here. Now, continuing down, everything in the terms of the sector ETFs was also down, with technology XLK down the most, followed by discretionary. So really, again, a risk-off week. And for the week, we did see a slight boost for. This is the day. This is the day, and now we're back to the week here. So we did have some things positive for the week. XLK was not one of them, but XLP, so defensive, XLRE, real estate, XLU utilities, took it as the winning sector spider ETF, followed by XLY, largely driven by Tesla, that has done pretty well, both for the month and for the week. So again, XLK was down the most for the week as well as for Friday. Okay. Moving on, this is the 15-minute chart of the SPY for the week. We finished last Friday with this crazy 15-minute bar, and then Monday morning we popped up to open here, pulled back slightly, kind of held in there all right, so elevated compared to the previous week's close. And then Tuesday we had, ended up filling the gap later in the day or midday, and then sold off, and then closed, with a little bounce back. Next day, and had some rolling back and forth. And then we come in Thursday, which was the first day of mid-month seasonality, which, as we talked about, wasn't supposed to be slated too strong, but it became a rally monkey day. So we pushed up. That gave us a pretty big premium for expiration Friday, which was expected to be down. So you actually had two compounded seasonalities. You had still mid-month seasonality signaling down, and you had expiration signaling down. So it's great to have some premium prior to that type of setup. And so it did not disappoint. We ended up having some high signal on the sell-off here. So sliding down the lower Bollinger Band and breaking levels like this bar here. So pretty high signal, and closed relatively close to the low of the day. That's how we finished for the week. This is a map of the market. Again, it's for the week, and you can see Tesla's performance at 10.42, again, driving the consumer cyclical, or we relate to it as consumer discretionary. Okay. We had bad performance for the week from Apple based on sort of the lack of adoption of lower sales really with products in the US. And then, of course, the Chinese ban didn't help anything. So that's Apple pulling things down. Oracle had a bad week. Adobe had a bad week. AMAT. So a lot of the semiconductors and IT area was hit. Contrary to that, banks were doing pretty well. I think on the back of expecting maybe rates to stay higher for longer, maybe even putting on the table, maybe the Fed will do one or two more hikes. Who knows? But they were strong, and then utilities, of course, you see some good strength there. So a lot of interesting mix in some of the groups, like, industrials, for example, GD, NOC, some of the aerospace. It's really interesting to see a contrast of like RTX down 9.2%, where NOC, Northern Grumman, up 2.55, or General Dynamics up 2.84. So I always find that interesting. The haves and have-nots of the group. And let's roll into a review. We did it last week, but just review because we're still in mid-month seasonality until what, Wednesday? Yeah. 9th, 10th, 11th, 12th, 13th, 14th. So we're still, we've got mid-month seasonality, but now we do wait the first 2 days of seasonality. And so it's the 9th through 14th business day. So we kind of wait the first two heavier, but it may continue. It's possible. So you want to familiarize yourself with some of these groups again. Anything, Dave, that you want to remind people of for exposure here?
Really, it's like the next days 1 through 2 are the heaviest in terms of that seasonality. Yeah. But we could still see some extension of it for the next 3 days.
Right. Now, we did see a little bit of weakness in XLE last week compared to some of the other sectors. Oil has been strong, but the energy sector itself pulled back. And this is saying for mid-month seasonality, though, that it's only 37.5 chance of going down. So make sure when you're looking at these things, you're incorporating both the odds of this average performance occurring. So what's stronger would be 75 or 80 for a move, right? So we saw that last week XLC did pretty good. So we're still in mid-month seasonality. That still might be kind of the umbrella context over it. So keep that in mind, that it could kick in. So that's what's helpful about it is that even if you have the probability of something declining, but it's actually stronger, but the seasonality window is still open, it could happen later in that seasonality window. So just familiarize yourself with that again. So that was the ETFs. And then also, here's the symbols.
Friday was dead on with the almanac. I mean, it was a very weak day.
Right.
We gapped down and kept getting weaker. So the third Friday almanac data was correct, and also the mid-month was pretty dead on as well.
Yeah. So I mean, it and we still have some time to go in that. So we tend to look at seasonality as a pretty good probability umbrella, and maybe even stronger than some of the other indicator-based stats. But that doesn't mean that it's always going to work, and it depends on how you get there. If you have premium ahead of a decline expected, well, that's great. If you have discount ahead of a rally expected, that's great. So just run through and frame it, and some of these choices will be better setups than others. Okay. So the stocks, you just again want to find the ones that are aligned with the ETFs. So you're looking for the worst performing stocks in an ETF for the short side, or the best performing stocks in an ETF for the long side. Economic calendar, run through some of that, Dave?
Yeah, throughout the week, there's a couple themes, a little bit of housing data early in the week, jobless claims later in the week, and just the conditions of the services and manufacturing data on Friday. But the key thing this whole week is going to be about the Fed decision on Wednesday. It's a 2-day meeting, starts on Tuesday, and then Wednesday at 2 p.m. we get the interest rate decision, followed by a 2:30 p.m. Press conference with Chair Powell. And then also Friday, we have some more Fed speak. There's Lisa Cook, Minneapolis Fed, San Francisco Fed. So Fed talk and the interest rate decision is really going to color the week. But market really thinks that there's not going to be a change in interest rates this time. There's a 97% chance that the Fed will keep rates the same, according to the CME Fed Watch tool. But if there's a surprise rate increase, that can throw the market off. So.
That'll give us a party, all right. If they actually come and do a 25 hike, that would shock the market, because it has not been anticipating that. Mm-hmm. And we've been already getting a decline coming into this meeting. So, that means there's other risk factors circling. That would be something that could break the camel's back for probably a short-term decline if that happens. So again, very low probability of any hike, but hey, that never can be sure. That's why it's 97% and not 100 guaranteed, right?
Yeah.
So, and then we have that PMI on Friday, which may have something to it. So we'll see. All right, here's some notes I put together. So potential government shutdown that could harm investor confidence and growth. So this is coming. We do have the budget that has to be sort of in place by the end of September, so September 30th. And so we're on that's still something that's circling here. We have the UAW strike against all three legacy Detroit automakers, Ford, General Motors, and Stellantis, and they're demanding, job security and better wages. And these unionized workers are utilizing a tight labor market inflation and other risks to give them leverage. Beyond the UAW, this could empower other unions presenting risks to the economy, right? Did you see that happening, Dave, where this sort of sets a precedent and empowers other unions to also fight? Would that not be inflationary?
Totally. The wages aren't going to just go up and nothing happens. It's going to be spread to the consumer.
For sure. So we could be in for quite an interesting, year. And also that the government's policy is that it's supporting these workers. So in Biden's address, he did say that, the record profits of these companies should be spread to the employee. And I'm not going to say that's right or wrong. I mean, I'm just saying that that's the stance of the government that's behind this. So that's certainly going to empower other unions. North Korea is selling munitions to Russia after meeting with Putin and Kim. So there's already been, I think, some of that, but it will increase. And that could present more hot war risk down the road. Meanwhile, it's probably going to support the Russia-Ukraine thing. But anyway, we don't like to see that going on. In its biggest antitrust challenge yet, Google is being sued by the Justice Department and state attorneys general, possibly resulting in a 25-year-old company being broken up. So that's interesting, along with Apple, as we mentioned earlier, facing declining U.S. sales and Chinese regulatory curbs. Both these mega caps, if they're under pressure, are going to set some tone and change some sentiment and possibly help pull the market down. Many corporations will be hurt by higher interest rates when they have to refinance next year. Many aspects of refinancing cannot be done in an orderly fashion with these elevated rates. And we expect rates to stay higher for longer, even if there's no any more hikes, it's going to stay elevated for longer. So this is going to put tremendous pressure. So when you combine this with, the economic reports that have been put out over the last year, and then we see these revisions being sneaked in, like it seems sneaky to me, because when no one's looking, there's a revision, and that revision might be telling the real story. I wonder if, the narrative can stay sort of optimistic when there's other things circling behind the scenes. Now we're going into 2024, which is an election year. So typically in an election year, incumbents, they pull out all the stops to support the economy and do what they need to do to get the votes and stay in power, blah, blah, blah. So, it wouldn't surprise me if there's some bullish things that can happen and, some sort of form of stimulus. Or, you could get another pandemic come along and then stimulus comes along as a result of that. But it could support the upside in the market. But other than that, there seems to be a lot of things swirling around for the downsides. Putting together some notes here. Credit card rates are rising in combination with delinquency rates. IRS is hiring 3,700 employees to target large corporations and complex partnerships. This comes from Biden's Inflation Reduction Act, which had a budget of tens of billions of dollars for the IRS to go after tax cheats. Not saying that these corporations are cheating, but the examinations on 75 of the largest U.S. partnerships will open at the end of this month. How do you feel about that, Dave? Is that a bullish or is this kind of a concern for investors?
That's a concern for investors. It's expensive to fight these things. There's concern. They're going to take different actions, expensive actions to prevent any scrutiny. So it's not good for business. No, and the budget. This is the budget of tens of billions of dollars is your tax money, right? Going after them.
And then they're going to have to spend money, like you said, to fight it. So then they're going to pass on those costs to you. So again, this is not only concerning, it's also inflationary.
So almost everything in the act is inflationary rather than deflationary.
Yeah, it says Inflation Reduction Act. Okay, all right. Yeah. Even bigger than Evergrande, collapsing home values threaten to harm China's economy. This could have a significant consequence on global growth. So it used to be said that when China sneezed, we caught the flu. I haven't seen it to that extent in recent years, but it's still possible, and it still sets a sentiment and a tone. So anyway, there's just some notes, and there's more things out there swirling. We have oil prices rising again, and that we don't see the top of that quite yet. U.S. dollar, another thing to watch. Treasuries, another thing to watch. So anyway, that's that. So we got one more thing to show ya. This is a kind of, if you use FinViz or not, but I find this an underutilized area. So often you use the screener to sort things and find things, but there's this under the maps, you've got the bubbles, not just the map that we typically show, but the bubbles area. But you can set your x-axis and your y-axis with all these different things, okay? So a great area to play around with. So for example, the y-axis I have as, or sorry, the x-axis I have down here as the simple moving average, and the y-axis as the target price. So here's Tesla's target price, right? Where is it related to its simple moving average? So the size of the bubbles is the market capitalization, right? So you can look at the different sectors by color, the different stocks. You can mouse over, see an actual chart of it, and so on. You can see how it's arrived there. But you can also select and do different things, like maybe you want to do, let's see, maybe you want to do a 1 week performance, because we just came out of a 1 week performance. And on the y-axis, you want to do, what should we do, Dave? So we could do, you could do PE or something like that. Well, that's kind of whacked out. Let's do something else here.
Market cap, I don't know.
How about we could do relative volume to see if anything pops out there. So it's like 1 week performance along with relative volume. So this had really high relative volume. So it performed for the week, substantially. So this is 0 point here. So this is performing negatively, and this is performing positively. But did they do it on really high relative volume? Well, this one was up 2% on really high volume. You can see the volume spike on the chart right there. LNC also up on significant volume. This one was down on significant volume. All right, so that's something you can do. You also could compare the 1 week performance to the 1 month. So this is 1 month performance here, and here's 1 week. So Tesla has, for the 1 week, we already mentioned earlier, over 10% performance, but also for the month, you're sitting at over 20%. So, what you could then do is go take some of these outlier things and pop them into StockOdds and see what it's saying for the next 5 days, for the next week. So there's, like I said, the screener is one way to get your attention, but you got to sort through a lot more information. Sometimes the bubbles just help you pick out something that you find interesting. And with all of these different filters to set it here, it's quite interesting. And you can also, focus in on bubble, change the bubble color, or you can change the index if you just want to look at the NASDAQ 100, for example, get rid of some of the other noise. If you want to just focus on a sector and say, okay, you know, I'm really interested in say the utilities. I want to see how they're laid out, right? I want to focus on, we don't have much utilities in the NASDAQ 100, so we'll put it back on the 500, right? I want to see how the utilities all relate to each other. What's this NRG doing way down here, right? What's AES doing down here? And then it brings your attention to say, what might it do the following week or the next day? Or so hope that helps. But there's, I mean, tons of things to play with here, right? You could get lost in this for hours and hours and hours, but maybe you can set up a screen and save it so that you load your preset so that you can always quickly get your information. And all of a sudden I'm like, I'm interested here. We've got 1 month performance for this NRG at 5%, right? But the 1 week performance, you know, was down here at 1%, minus 1%, right? So it didn't participate with these other things. So how did it get there? Let's take a look, right? So I find it very helpful, very useful, and just wanted to point that out, that I think it's really underutilized, and it might be of some assistance to you. Okay. Anything else, Dave? Oh, you got some earnings on any earnings next week?
Yeah,
anything popped out?
Yeah, 2 key earnings on Wednesday. There's FedEx, and then Thursday, Darden Restaurants. So gives us insight into consumer.
FedEx could be impacted by, you know, the rising prices of energy recently. We've had, you know, about this last quarter has been a little bit elevated from what it was before, so it might play into it. Also, FedEx could be having faced more elevated costs in some areas, or may, because of rising costs, had reduction in business because people are shipping less because of the elevated costs. So it could be an interesting earnings for that. Darden's Restaurant, are people starting to taper off on their eating out because of, you know, they burned through their savings, their credit cards rising, you know, getting full again? Are they starting to back off from eating in restaurants? So it's something to look at. Okay. All right. Well, thank you, Dave. Appreciate it. Have a good night.